Welcome to the Hurst Trading Room. This is our video update for the 18th of February 2013, and in this video I'm going to be introducing you to a new format for our Hurst Trading Room videos. Previously I've been recording a summary video and then detailed videos for each one of the four instruments that we have been tracking up to now in the Hurst Trading Room, and thank you very much for all of your feedback, which has prompted me to do things in a slightly different way. I am going to continue speaking about the four instruments that we have been tracking up until now, but of course the trading opportunities in those four instruments have been fairly few and far between recently because of the dominant cycles that are active in the US markets. And so I'm going to start looking at some other instruments in this video, and I'm going to be doing that every week from here on. I'm going to record one video in which I'm going to present a range of new trading opportunities. We're going to look at different analyses and different instruments and try to identify trading opportunities that are coming up, because as many of you have pointed out, that is the real value of the Hurst Trading Room, is that we can identify new trading opportunities. I'm also going to try to keep my comments as concise as possible. I know how precious time is, and I do like to go on about cycles in markets, but I am going to try to keep these videos as concise as possible. Please do provide me with feedback on this new format, and as always put comments into the box below the videos and let me know how you feel about it, and also let me know which instruments you would like me to include. I'd be delighted to look at instruments that you are interested in trading and see if I can provide some insight in terms of what I think might be happening in the analysis or the cycle activity in those instruments. In this week's video, I'm going to be looking at our four regular instruments, which of course I will keep doing. And I'm also going to be taking a look at crude oil and at the US dollar to Japanese yen forex pair, which are two instruments which have been requested. So without further ado, as long as you have had an opportunity to read these disclaimers, let's move on and take a look at the markets. First of all, let's take a look at the S&P 500. And as you know, for some time now we have been standing by to enter into a short trade, and that could either be a category F short trade or a category B short trade. Now I'm tracking two analyses in the S&P 500 and also in the Nasdaq, and so in the S&P 500 I'm focusing in this video on the most likely analysis that I think is playing out in the S&P 500, which tells us that the next trade is a short B category trade. Of course, I only take a short B category trade following a straddled, or in fact a hidden 80-day cycle trough, which is what I believe has happened in these markets. Instead of repeating everything I've been saying over the past several weeks, let me just give you the highlights here. The first thing is that, of course, I believe there was a 20-week cycle trough in the middle of November last year, 2012. And then the fact that we saw a fairly clear and simple cycle shape developing for this first 40-day cycle. Here's the 40-day cycle trough at the end of December 2012, 40-day, and this is 20-week. The fact that we saw a very clear 40-day cycle developing implied that we might well be witnessing the emergence of the 20-week cycle as a dominant cycle in the US markets. And that is indeed what seems to be happening. What does that mean? It means that we will see a very clear shape for the 20-week cycle. That's the first thing that it means. The second thing that tells us is that we should expect a very subtle, hard to identify and a very small trough for the 80-day cycle. And as you can see in this analysis, that is what I believe happened. In fact, I think that 80-day cycle probably formed in the first week of February. And so what are we expecting now? Well, of course, we're expecting the market to peak as it forms the peak of the 20-week cycle, turn down and head down to this big nest of lows, which will be the 18-month cycle trough that, of course, we've been expecting for a long time. or at least not expecting it, in that it's not really very overdue, but we have been looking forward to the formation of that 18-month cycle trough. And as you can see, this nest of lows is slightly staggered to the left, and the actual date in which this 18-month cycle trough is expected to form at the moment is towards the end of April. Of course, as the cycle picture unfolds, we can refine that until we have a much clearer idea. But the end of April is a pretty sort of a rough estimate for now for when that trough should form. One of the very interesting things that happens when you have a dominant cycle, and you therefore have a hidden or subtle smaller trough, in this case an 80-day cycle trough. One of the interesting things that often happens, and I wrote about it in this week's blog, if you take a look at that, is that you will often see a straddled trough of the cycle 1 degree shorter forming. So it is possible that we will see a straddled trough of the 40-day cycle forming. What would that mean? That would mean, and I'm going to very roughly sort of show you what might well happen with price movement. Price will come down and form the 40-day cycle trough, which is expected in about the second week of March, as you can see. Then it will form a straddled trough there. In other words, it'll form symmetrical price action around that trough. So you can see I've drawn a symmetrical price action, and then of course price will head down into this trough over here. I wouldn't be surprised at this point to see price action a little bit like that. And so what do we do in terms of trading, the FLD trading strategy? Well, here is our 80-day cycle trough, which was a either straddled or hidden cycle trough. It's the same thing effectively. It means that what we're going to do next is take a B category short trade at the point at which a price crosses the FLD. So that's what's happening in the S&P 500 at the moment. Let's take a look at the Nasdaq. In the Nasdaq, as I've already mentioned, I'm tracking the alternate analysis, and that of course has the November trough as a trough of the 18-month cycle, which means that then the trough at the end of December 2012 is most likely a trough of the 80-day cycle, as you can see over here. And as discussed last week, the 40-day cycle trough most probably came in at the beginning of February. And so what are we expecting next? What we're expecting next is an F category short trade. And of course, the sequence of trades is very difficult to identify. And so if that bothers you, then the best advice really in terms of the Nasdaq is to step aside a little bit. When things get difficult to identify, it's best not to trade. But if that doesn't bother you, then of course the F category short trade is next. And as you can see here, I was actually stopped into that F category short trade last week as price came down to the 20-day FLD. And I took a very small position in the Nasdaq because there has been so much uncertainty in the Nasdaq. So you certainly don't want to go in with a really big position when there's been uncertainty. As price came down and crossed below the 20-day FLD, I was entered into what is probably an F category short trade in this market. Notice something interesting with our take profit levels over here. They are very close together. And the reason for that is because, of course, by the time median price had finally crossed below that FLD, which in fact probably only really occurred late on Friday or even over the weekend, the projection caused by price crossing below that FLD from this peak over here down to the price cross level, which is probably somewhere over there. There's my crossing point. Down to the target is a much lesser target than it would have been if price had continued to move strongly below the FLD, which of course it didn't do. So that's the status in the Nasdaq at the moment, that it is in a short F category trade. I'd like to step back just for a moment in the Nasdaq and take a look at the slightly bigger picture. In the S&P 500, I spoke about the fact that there was a 20-week dominant cycle. And in the Nasdaq, of course, the dominant cycle is slightly different, but that's because we're looking at an alternate analysis. So what is most probably the dominant cycle in the Nasdaq at the moment? Well, I mentioned a very easy way of determining what the dominant cycle is in the market is to take a look at a clear shorter cycle shape, and in this case that is an 80-day cycle. So there was a very clear 80-day cycle shape following the formation of the 18-month cycle trough according to this analysis. That implies that, of course, 2 cycles longer, in this case the 40-week cycle, is probably dominant in the Nasdaq at the moment. What's the next thing that we can expect when we know that there is a 40-week dominant cycle? The next thing you know to expect is that the cycle 1 degree shorter than your dominant cycle will have a very subtle, hard to identify trough in the market. And of course the cycle 1 degree shorter than the 40-week cycle is the 20-week cycle. Notice this nest of lows here at the bottom of the chart tells us that price is now probably in the process of moving down into this 20-week cycle trough, okay, which is expected towards the end of February, perhaps early March. And because we have been able to identify that there is a 40-week dominant cycle, we know that this 20-week cycle might prove to be subtle. It might prove to be quite hard to identify. What does that mean? It means that it is very possible that the move down into this 20-week cycle won't be as strong as one would normally expect the move down into a 20-week cycle to be. All right. So although I am in an F category short trade, I am not sitting here feeling very optimistic about that short trade, because I do believe that in fact the move down into that 20-week cycle trough might prove to be disappointing. And so it is important to get into the market, I believe, as the market starts moving to fulfill its cyclic destiny. But on the other hand, we need to keep a close eye on this trade, because if that 20-week cycle trough proves to be very disappointing and very small and subtle in the market, then of course we need to set our stops tight to be careful that we don't get caught out as price bounces out of the 20-week cycle trough. Let's take a look at the British pound to US dollar. Now, the British pound to US dollar recently has been a little bit tricky. Of course, it was my favorite instrument for a good long period of time because we had a perfect sequence of profitable trades, A, C, and then F category trades, which proved to be a perfect sequence of very profitable trades. And what's happening now is that, of course, the market's coming down to form this 80-day cycle trough over here. Here is the nest of lows, which, as you can see, is getting stretched. And that is either because the 80-day cycle trough did, in fact, occur over here, as we discussed last week. It is possible that at the beginning of February that 80-day cycle trough did form, and that what has happened since then is the price bounced for only a few days out of that 80-day cycle trough and is now heading down again because of the bearish pressure of the longer cycles. That is possible. The other possibility is that we've had a really fairly complex G to H, or in this case a double G to H interaction. The first G to H interaction, of course, occurred right back over here. That was our G, and then H interactions as price broke down again. We, as discussed last week, probably had a double G to H interaction, and it is possible that in fact this double G to H category interaction just turned out to be fairly complex. So price tracked along not perfectly by any means, and price doesn't have to track perfectly along an FLD for it to be a genuine interaction. There is often imperfection in the markets, and the important thing is to keep a clear head when you're looking at it, and be aware that this might simply be a long, protracted, not very perfect, but perfectly possible double GH interaction. If that is the case, then of course we're still expecting the 80-day cycle trough to form. We were able to make a profitable trade last week, or about 10 days ago, out of the bounce out of this possible trough over here at the beginning of February. But price might now, probably this week sometime, be forming the actual 80-day cycle trough. And so what will we be doing? taking an A category long trade as price bounces out of that 80-day cycle trough. That's the situation in the British pound to US dollar. Let's take a look at the euro to US dollar. Now, I have been tracking two analyses in the euro to US dollar recently, and this analysis, as you can see, I've called it short cycles, and it tells me that this is an analysis that implies that the cycles have been running fairly short recently in the euro to US dollar. And which cycles in particular? Well, this 80-day cycle, which spanned from the 20-week trough in middle of November to the first week of January. As you can see there, that is an 80-day cycle according to this analysis, and it makes a very short 80-day cycle. I think it was about 52 days. So it's a short 80-day cycle. That's why I call this my short cycle analysis. And what does that imply? Well, that implies that price is now coming down into a 40-day cycle trough. And let's take a look at the FLD and price interactions that this analysis provides us with. First of all, there is this crossover here, which was an A category interaction, which we were able to take profitable trades on the basis of. And then, of course, there was the B interaction, which was over there. It looks like a very good typical B interaction. Price comes down to the FLD, doesn't cross strongly below it, but sort of tracks along it for a few days and then bounces back up again in a C category interaction. Again, we took profitable trades on that C category interaction. Then we saw a D category interaction over there. And again, we made some profit out of that trade as well. We had one break-even trade, and the other two trades were profitable from that trading opportunity. And so, of course, the next thing that we are expecting, according to this analysis, is an E category long trade. That's according to this analysis. And so far, everything looks good for this analysis. But what happened last week starts raising a few questions about whether this analysis really is the correct analysis. Let me just zoom in a little bit and show you exactly what I mean. Here you can see price bounced up towards the FLD, and here is the FLD, and bounced up towards the FLD and then traveled along below it, which is looks a little bit as if though it's tracking along that FLD. Now, we don't expect price to track along an FLD between a D category and an E category interaction. It's not to say that it's impossible. You must remember that our sequence of FLD and price interactions is a guideline. It's something we observe again and again in the market, but there are many variations, and sometimes the markets just do things that are slightly different to what we expect. So it's not impossible that we are still seeing price falling into the 40-day cycle trough as indicated here, and that it will bounce back up, and that will be our E category interaction. That is not impossible, but of course we are also tracking another analysis, and that other analysis gives us a different perspective. So according to this analysis, we are still expecting our E category long trade next, according to this analysis. Let's take a look at the alternate analysis. And of course the reason why we track alternate analyses and consider them is because often an alternate analysis can give you a clearer insight into what is actually happening in the market. This analysis is what I call my long cycles analysis. There is still a 20-week cycle trough in the middle of November, but this trough, which was the 80-day cycle trough and the first week of January in the other analysis, is here the 40-day cycle trough. So let's take a look at the sequence of interactions here. Here is the A category interaction, here is B, here is C. Not a perfect BC, because normally we expect to see tracking between B and C. There was no tracking there, but the markets aren't always perfect. And here's our D category short interaction. Again, not perfect. We're seeing a bit of tracking there. We don't expect to see tracking. And here was our E category long interaction. And then there was an interaction here which doesn't really fit into this analysis. We shouldn't really see price interacting with the FLD, between the E and F category interactions. So again, that's another question mark on this analysis, and this is why this has been my less preferred analysis. And this short trade, which of course we did take, was an F category short trading opportunity, or an F category interaction between price and the FLD. And then what do we expect to see next? Well, we expect to see a GH interaction where price comes back up to the FLD and then tracks along it and then breaks down below it. So what happened last week is very possibly the G category interaction, which this analysis tells us is a distinct possibility in this market. That's why it is very important to keep an eye on different analyses when there are possible alternate scenarios that are playing out in the market. So if in fact that does turn out to have been a G category interaction, then we would expect the euro to US dollar to fall a little bit further down, probably in the H category interaction. Well, it's not impossible that it has found its 80-day cycle trough over here, which is right there, bang in the middle of this nest of lows. It's not impossible. But we would probably expect a little bit more downward movement according to this analysis. And what would be the next interaction that we would trade in the euro to US dollar? Well, that next interaction would of course be a long A category interaction. So no matter which analysis it turns out is the true analysis, we are looking for a long trading opportunity next. However, this long cycles analysis provides us with a bit of a warning. We've seen in the British pound to US dollar how you can often get a double GH interaction, and we see it all the time in the markets. Double GH interactions are something you've got to be very careful of. You've got to be very wary of them, and certainly if we see double GH interactions occurring in the euro to US dollar, then we've got to be careful about jumping into that A category trade. I am not expecting double GH category interactions in the euro to US dollar. Why? Because you normally see double GH category interactions when you have a lot of bearish pressure from the longer cycles. And as you can see, and let's just zoom out on this chart, there isn't a lot of bearish pressure from the longer cycles in the euro to US dollar, because, of course, we very recently saw the formation of an 18-month cycle trough over there. And so, although the 40-week cycle has no doubt turned down by now, the 18-month cycle is most probably still pushing up, and it looks as if that's pushing up fairly strongly. And so, I'm not expecting to see double GH interactions, but you must bear in mind that it is possible. Now, let's take a look at a new instrument, something we haven't discussed before in the Hurst Trading Room, and see if we can identify some trading opportunities in that instrument. I thought I would take a look today at crude oil, because we have had crude oil requested, and crude oil actually provides us with a very interesting picture, and it also provides us with an analysis that helps us to perhaps clarify or perhaps see a little more clearly what is happening in the S&P 500 and in the US markets generally. Often crude oil and the US markets move very much in sync, but they beat to a slightly different rhythm, and that makes an analysis of crude oil really very interesting. This is what I believe is happening in crude oil at the moment, and I'm determined not to spend too much time speaking about all of these things. I want to try to keep this video as short and informative as possible. So I'm just going to show you the sort of real basics of this analysis. And the first thing to note is that in early November, not in fact mid-November, but in early November, there was a trough of the 20-week cycle. And it occurred about a week before the same trough, the 20-week cycle trough, in the S&P 500 that we looked at a moment ago. And so there's a great degree in common. You'll often see markets having slightly syncopated troughs occurring a week, perhaps 10 days apart. It's not uncommon at all. And so that's what I believe we saw in crude oil, a 20-week cycle trough on about the 7th of November, and we then saw a fairly clear 40-day cycle shape unfold. By fairly clear, I can draw a very nice M shape there. You see that really clear M shape? That was the 40-day cycle. There is the 40-day cycle trough marker, and so a very clear 40-day cycle is an indication that possibly the 20-week cycle has risen to dominance. How do you do that? You simply go up 2 cycles longer than your clear cycle. So this is a 40-day cycle, and the next longer is 80-day, and that tells us that very possibly the 20-week cycle is dominant. If the 20-week cycle is dominant, what do we expect? We expect, of course, a very subtle 80-day cycle trough, and here it is. This is, in fact, when I think the 80-day cycle trough occurred in the second week of January 2013. It is indeed a very subtle trough, all right, because price came down, as you can see, for only 1 day. That's a very small trough for an 80-day cycle. Now, we could argue this, we could debate it, we could possibly place the 80-day cycle trough over here, or we could place the 80-day cycle trough over here. Those are all possible alternate analyses that I would encourage you to look at and create charts to monitor those alternate analyses. I'm presenting here my preferred analysis. This is what I believe is happening in crude oil at the moment. The other thing that, of course, we expect when we have a 20-week dominant cycle is that the market will generally show us a really clear, strong move up for the 20-week cycle. It'll form a 20-week cycle peak somewhere, and then, of course, it'll move down fairly strongly. So, in other words, we expect a clear 20-week cycle shape. With retrospect, we'll look back at it and we'll say, oh, that's an obvious 20-week cycle. Okay. The next thing that often happens in markets, and I spoke about it when speaking about the S&P 500, but the next thing that often happens when you have a 20-week dominant cycle is that, of course, you have a subtle, either hidden or straddled 80-day cycle trough, and if that trough is hidden, in other words, it's really hard to see, as I pointed out, you've got to have pretty good eyes to even see that 80-day cycle trough. So if that's a hidden trough, then I've learned that very often you will see a straddled 40-day cycle trough forming after that. And in fact, I believe that that is exactly what has happened in crude oil. And let me just clear this and show it to you. Here is our hidden 80-day cycle trough. We then expect the next 40-day cycle trough to potentially be straddled. What does that mean? It means that I expect symmetrical action around the next 40-day cycle trough. I believe that the 40-day cycle trough most probably formed over here. It's a question mark, but I think that the 40-day cycle possibly formed over there, and I expect it to be straddled, which means I expect the price action around that trough to be symmetrical. Can you see that price action has, in fact, so far been very symmetrical? Okay, we're getting what looks like a very clear, a very good M shape. All right, so that's what I'm expecting is happening in the markets at the moment in terms of crude oil. So what are our trading opportunities? Well, let's quickly identify our FLD and price interaction sequence here in crude oil. Of course, because we had a subtle 80-day cycle trough, either hidden or straddled, the A category interaction doesn't even exist in the markets. It's something that you often see when you have a hidden or subtle trough of any kind. The A category interaction simply isn't there. Where was the B category interaction? Here, as price came back down to the FLD, it bounced off it. So that was B over there. C occurred as it bounced off it. D, as price crossed below the FLD, formed the 40-day cycle trough, as I've mentioned. I think that's probably the 40-day cycle trough. Our E category interaction was over there as price bounced back out of it. And what are we expecting next? We're expecting an F category interaction as price crosses down below this FLD and carries price down towards the 20-week cycle trough, which is at present expected towards the end of March. All right, so that's what I believe is happening in crude oil. I think that there is an F category short trading opportunity shaping up in crude oil. Let's take a look at our final instrument for today, and that is the US dollar to Japanese yen. I've had a few requests actually to take a look at the US dollar to Japanese yen, and the big thing that's been happening in terms of the Japanese yen. It doesn't matter which other currency you cross it with. The Japanese yen, as you can see, has been falling in value really strongly, and so as a result, we're seeing this really big straight line up in our charts. Okay, so what's happening in the US dollar to Japanese yen? Well, let's first of all zoom all the way out on this chart. And we first of all need to speak about something fairly important. And that is that I believe that the Japanese yen, any forex pair which involves the Japanese yen, requires us, in fact, to perform an inverted analysis. Because I believe that the cycles, when considering the Japanese yen, are inverted. In other words, peaks are synchronized and not troughs. And so we will take a look at a moment at an inverted chart. And I certainly think that trading decisions at the moment in the Japanese yen should be conducted on the basis of an inverted chart. We'll take a look in a moment at an inverted chart. Let's quickly speak about the analysis the right way up, which of course involves synchronized troughs. And let's see if there's anything that we can see in terms of this analysis which assumes that the troughs are synchronized. Some people get very worried about whether they should be performing an inverted analysis or a normal analysis. And in fact, the differences between them are often fairly subtle, and I don't think it's the end of the world if you end up trading an instrument using a normal analysis when you should be using an inverted analysis. It's not the end of the world. Your analysis isn't going to be perfect, in my opinion, but very often you can gather some very interesting information out of an analysis that's been performed using synchronized troughs. So let's quickly take a look at what this analysis is telling us. Here, first of all, we can see a very clear shape, a sort of a cycle shape that has manifested in the US dollar against Japanese yen. And I think you can see that there are 1, 2, 3, 4 18-month cycles in that very clear shape. Now, in the S&P 500, as you know, I have spoken often about the harmonic of a 6-year and a 3-year cycle. And in fact, I believe that something very similar has been happening in the Japanese yen. And of course, 4 times 18 months is 6 years. Okay, so that's the first thing that jumps out at me about this chart, is that we're seeing what looks like a pretty clear 6-year cycle. And as you know, I have many thoughts about why we see 6-year cycles in the markets, and I've spoken about them in other Hurst Trading Room videos, and there's a lot of stuff about that in Module 5 and in Module 6 of the FLD Trading Strategy course, because harmonic cycles are very important cycles to consider. So that's the first thing that I notice immediately, is that possibly we're seeing some harmonics here. There's a 6-year cycle at work, possibly even a 3-year cycle. Let's zoom in and take a little more detail in, and let's get rid of the semicircles. There we go. So ever since the most recent 18-month cycle trough, according to this analysis using synchronized troughs, we have seen a fairly clear 40-week cycle, as you can see. All right, and that 40-week cycle, as a matter of interest, implies that 2 cycles longer is dominant at the moment. What's 2 cycles longer? 54 months. Okay, some people might argue that. Some people might say, in fact, there's a 3-year dominant cycle. All right, but what it does tell us is that there is a very long dominant cycle that we're seeing at play here. And that's one of the reasons why recently in the Japanese yen we have seen the development of what Hurst called a super trend, which is when it looks as if though all the cycles have just given up the ghost and one cycle has taken over and it's just driving this instrument really hard. It makes it very difficult to trade when you see the development of a super trend, because you're simply not getting the smaller cycle fluctuations that you expect. They're all being hidden, and of course you know that they're being hidden now because of the fact that there's a very powerful dominant cycle. Whether that cycle is a 3-year cycle, a 54-month cycle, or a 6-year cycle isn't terribly important. The important thing is that it's a pretty long cycle. And if we're trading the 20-day FLD as we are, and we have a very long cycle like that, which is so powerful, it does make it very difficult to trade. So let's just have a look at what might be happening, assuming that we have synchronized troughs. Okay, we saw a 40-week cycle trough forming according to this analysis back in September of 2012, so that's 40 weeks. And ever since then, the market has just been moving in a straight line upwards. Now, of course, you know that according to Hurst cyclic principles, cycles don't disappear. And the 20-week cycle, it has been 22.7 weeks, as you can see here. The 20-week cycle has almost certainly formed a trough in the meantime. And it is, of course, a subtle trough. There's no question about that. It's very hard to see it. It's very hard to identify it. Do we expect a subtle trough? Well, yes. If the dominant cycle is 40 weeks or longer, then we do certainly expect to see a subtle 20-week cycle trough, and that is exactly what has happened. It was most probably a hidden 20-week cycle trough. But nevertheless, it's in there somewhere, and it is most probably right there in the middle of January 2013. That's probably when the 20-week cycle trough actually formed, although it was hidden. What are we expecting now? Well, of course, we're expecting the market to turn down and head down into this 18-month cycle nest of lows, which is expected sometime in May. But now I spent a little bit of time explaining how there is either a 3-year, 54-month or 6-year dominant cycle at work in this market. So do we expect a very strong move down into that 18-month cycle nest of lows? I'm certainly not holding my breath for it. When a super trend develops, as has happened here, and a super trend is when the market just gets suddenly stretched one way or another. When a super trend develops, it's a very difficult and dangerous thing to do, to try to catch the end of that trend. So I am expecting the Japanese yen to pull back, not the Japanese yen to pull back, the US dollar Japanese yen forex pair to pull back into this 18-month cycle trough expected in May. But certainly we have to be very careful about getting into trades on the basis that the market is turning down into that 18-month cycle nest of lows. Certainly any trading decisions in the Japanese yen, I believe, should be taken on the basis of an inverted analysis. So let's take a look at that inverted analysis, and here it is. And let's quickly zoom out and see what we can see here. Right, and let's zoom in there. There we go. Now, again, we can see a very clear cycle shape already manifesting over here. And again, we can count the 18-month cycles. There's 1, 2, 3, and we're now in the 4th 18-month cycle. And so again, we're seeing some evidence that there is a very long dominant cycle. I won't emphasize it, but it certainly looks very much as if though we have some kind of a 6-year harmonic which is playing out here. And that would certainly imply that the next 18-month cycle peak, which the market is heading up towards now, might prove to be a very prominent peak. Okay, let's zoom in and take a look at a little bit more detail and see what has most probably been happening recently in the market. Well, as you can see from these bar counts, perhaps you need pretty good eyes to see them, but I've been counting the bars, first of all, from the most recent 18-month cycle peak over here, which was in March of 2012, and there have been 48.6 weeks, okay, 48 weeks. And so one of two things is happening here. Either there was a hidden 40-week cycle peak somewhere back over here. There's a possible one. Either that was a hidden 40-week cycle peak and the market is now heading up towards the 18-month cycle peak, or in fact the market is round about now forming the 40-week cycle peak. And as you can see, according to this analysis, this is my preferred analysis, according to this analysis, that is what is happening. The market is now forming the 40-week cycle peak. And it looks as if though there is also, because remember there can be more than one dominant cycle, it looks as if though there is a very dominant 40-week cycle. You can see it very clearly there. We had a very subtle hidden. In fact, it was a straddled with symmetrical price action 20-week cycle peak over here. So there's the 20-week peak, which occurred in August of last year, and that's a really good example of a straddled peak. I have to be careful not to say trough. I'm so used to saying trough when we're dealing with an inverted analysis. You must remember that you're speaking about synchronized peaks. So there was a very good example of a straddled peak in August of last year in the US dollar to Japanese yen. And that, of course, is what we expect when there is a dominant 40-week cycle. And it looks as if though the market is now coming up and is in the process of forming, or possibly even formed last week, the 40-week peak. Okay, so let's take a look even a little bit closer at this analysis and see if we can figure things out. Okay, let's take a look at the most recent 80-day cycle. There we go. And let's see if we can start identifying some FLD and price interactions here. According to this analysis, the 80-day cycle was over here. Of course, it's hidden by this text, but let's not worry too much about that now. Our first interaction was our A category interaction, which was, in fact, let me change the zoom so that we can see it. Okay, let me just pull that chart up. There we go. That's the easy way around it. Okay, so our 80-day cycle peak was over here. Our A category interaction occurred over here as price dropped down from the 80-day cycle peak. Then we would have expected our B and C category interaction, and our B and C category interaction occurred as price came back up to the FLD, and there is our B category interaction. Why does that not look like a very typical B category interaction? Well, because, remember, following a straddled or hidden or subtle 80-day cycle trough, the B category interaction is often, in fact, an impressive cross, and that is exactly what happened over here. We did have a very good B category. It offered a profitable trading opportunity, put it that way. Then our C category interaction occurs over here. Our D category interaction over there as price breaks back up again to form the 40-day cycle trough. At that point, of course, the super trend had really started seizing control, or the dominant cycle had started seizing control, and it becomes very, very difficult to identify any of the interactions following that. It is possible that over here we saw the E category interaction followed by an F category interaction over there. And of course, after that, we would expect a few GH category interactions. So it's possible that over here we saw a G and an H, and price might have formed its peak over here last week. In fact, I think that is last week Monday. That is possible. But now remember, when you have a lot of either bearish or bullish pressure in the case of an inverted analysis, and we certainly do have a lot of bullish pressure, right? I mean, you can see it. That's what's been causing this super trend. We have a dominant cycle. We've got a lot of cycles that are clearly pushing the market up now. And when you have bullish pressure in an inverted analysis, you must be careful of double GH interactions. So I am being very careful of double GH interactions. And on Friday, price came down to the FLD. I didn't make a trade there because I'm being wary of a double GH interaction. You've always got to be careful of that. And so it's very possible that we saw a double GH interaction last week Friday, and price will come up a little bit higher, perhaps form a higher peak, and that will probably prove to be the peak of the 40-week cycle. And at that point, I would enter into an A category short trade. So what is our trading opportunity in the US dollar to Japanese yen? Well, it is an A category short trade, in my opinion, which we are expecting to see next. But we've got to be very careful that the super trend has run its course, that the dominant cycle has finished doing what it's doing. And so I would want to see fairly clear evidence that the markets had turned. So I would probably not enter into my A category short trade at the level of the FLD, which is bound to get really close to price in the course of this week. I would start setting entry levels below recent lows. Okay, set a price level entry. So that's what I believe is happening in the US dollar to Japanese yen at the moment. We're looking at an A category short trading opportunity next. And that concludes our video update for the 18th of February 2013. I do hope that you have enjoyed our new format, and I hope that the introduction of new instruments into the Hurst Trading Room is something that you are enjoying. Please give me any feedback that you can in the comment underneath this video, and I look forward to seeing you next week in the Hurst Trading Room, and of course profitable trading.